In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, President Trump tweets that tariffs are, quote, the greatest. Meantime, dozens of business leaders travel to Washington to argue that the policy is cutting into profits and forcing them to raise prices. Plus, big tech flies past a high bar. Google delivering a monster quarter, sales beating all estimates. But one investor is turning his back on tech. We will discuss why. And we give you an update on the Fortnite phenomenon, how one person struck it rich thanks to the game that's been played by 125 million people. First to our lead. It is no secret that President Trump loves the idea of a trade war and tariffs. In fact, the president made that apparent Tuesday, tweeting, "Tariffs are the greatest. Either a country which has treated the United States unfairly on trade negotiates a fair deal, or it gets hit with tariffs. Simple as that. And everybody's talking. Remember, we are the piggy bank that's being robbed. All will be great." But not everyone agrees with the president, of course, including the semiconductor industry. SIA, an association which represents the likes of Qualcomm and Intel, submitted comments to the U.S. Trade Representative's public hearing Tuesday that Trump's tariffs will, quote, undermine U.S. technological leadership, cost jobs, and adversely impact U.S. consumers of semiconductor products and the U.S. semiconductor producers. Joining me now to discuss in New York, we have Bloomberg's Chief Content Officer, Marty Schenker, and with me here in San Francisco, visiting from Tokyo, Bloomberg's Asia Tech Managing Editor, Peter Elstrom. Peter, great to have you here in studio. So what do you make of this pushback from the folks in the chip industry who say these tariffs are going to backfire?
Well, the technology industry is nervous about this because the supply chain for tech stretches between the United States and China in particular, especially for the chips companies. They're shipping a lot of product into China. Those are being assembled into finished products and then shipped back across the ocean. So they're kind of straddling this industry on both sides of the ocean. They're nervous that if this trade war gets out of control, it's going to cost them business. It could raise prices. It could cause other kinds of disruptions to the supply chain that's so essential to their business.
Meantime, Marty, we've got new news that the Trump administration plans to attempt to shield farmers from the impact of this trade war. Of course, we can assume farmers are a larger part of his voting base, but walk us through the conflicting issues at play.
Well, certainly Donald Trump thinks that tariffs are a great strategy to try to repair the damage of 3 or 4 decades of globalization. And there's a lot of people upset about it. It is true that he is going to try and shield some of the farmers from the damage, and he's asking for patience. Obviously, the semiconductor industry is not a hotbed of Trump support, so I doubt if you'll see some aid to the semiconductor makers or tech in general. But this does speak to Donald Trump's real view that tariffs are the way to go to get people to come to the table and strike better deals.
So far, Peter, the tariffs have been limited, $34 billion worth of imported products. They're talking about another $16 billion more today. And the president has said he's willing to go the whole hog, all $500 billion worth of products coming from China. What are the broader implications here?
Well, it would be a big issue for tech and obviously well beyond tech at that point, too. At the current level of tariffs, it's kind of an opening skirmish. But if you're talking about tariffs on $500 billion worth of products, that's everything that comes out of China into the U.S. That includes Apple's iPhones in particular. Remember, Apple's iPhones are designed in California, but then assembled in mainland China and shipped over here. So if they were to levy tariffs on those kinds of products, that would cause damage on both sides.
And Marty, it sounds like he's not just talking about China. When you look at his tweets today, he's talking about any country. I mean, what are the broader implications of this? Could this expand?
It very well could expand. Of course, we have Juncker from Europe coming tomorrow to talk to Donald Trump and try to defuse the situation. Watch for the results of those discussions for a clue about what's going to happen going forward. The longer term issues, as Peter explained, is the supply chain issues. If you're a company, you have to think about whether you need to permanently disrupt your supply chain plans if this becomes a protracted trade war.
And several companies have said that they might be forced to move outside the United States. Kimball Electronics, which is based in Indiana, just said so more recently. Peter, you're based in Tokyo. What is the view on this in Tokyo, in China, from the Chinese government?
I think generally they're nervous that this could disrupt a business process that's been very successful with them. China, of course, has grown into the manufacturing hub for so much of the technology industry, for so many more things beyond that, including apparel and automobiles.
Successful for them, but what about for the United States, which is exactly Trump's argument?
That is what Trump is calling them out on at this point. But they're nervous that this could go south.
So how could they retaliate? I mean, we've already seen some retaliatory measures, but we also haven't seen them go the whole hog either.
Yeah, the disconnect is that they can impose tariffs on goods coming out of the U.S., but it's not nearly as much. They, of course, have many other points of leverage, though. Take Apple, for an example. China is a very important market for Apple. It's the second largest market for them. They need to be able to sell their phones there. They've lost some ground against domestic competitors. They also run the Apple stores within China. That could be a point of contention. And then you have many other companies that are depending on China for growth and opportunities, from Starbucks to IBM to Apple, as we mentioned.
Marty, obviously this is a very unpredictable administration, but is there any sense of which direction this is going to go in? Is it going to get worse before it gets better? If it ever gets better, are we at risk of that? Or, is China at risk of those $500 billion of goods ultimately being taxed?
Well, I do think that ultimately Donald Trump likes to rescue situations he sets up himself. And so I've contended that at the last minute there may be some conversations on a personal level between Trump and world leaders, Xi in China, for instance, to try and resolve this situation. But I think it's going to get worse before it gets better, and it'll have to be the markets themselves and the economy that'll force these issues onto the table.
Similar to what happened, Peter, with ZTE, where Trump said, look, sorry, no dice, and then came back and said, actually, I'm going to save you.
Right. His own Commerce Secretary, of course, is the one who imposed the 7-year ban on buying American components, including the chips and the optical components that were essential to ZTE's survival. But then Trump personally negotiated. So, I mean, Marty makes a good point. He likes to be seen as savior in certain situations, even if he ends up initiating the troubles in the first place.
Right, and it certainly sets up a situation where then they feel like they owe the United States something. Marty, I have to ask you about the president's most recent tweet. I'm very concerned that Russia will be fighting very hard to have an impact on the upcoming election. Based on the fact that no president has been tougher on Russia than me, they will be pushing very hard for the Democrats. They definitely don't want Trump. This after, a year and a half of refusing to admit that the Russians meddled in our election?
Well, Emily, if you're trying to find logic in President Donald Trump's tweeting pattern, you should stop doing that. Obviously, he wants to change the narrative, and actually, some of Donald Trump's tweets are rather humorous. I thought this one was. He is trying to basically take the approach that it's the Russians who'd want him out as opposed to helping him as the Mueller probe is chugging along. So I think he's just trying to change the narrative, and I don't think you should think much more about it than that.
Well, in talking about playing to his base, like we discussed with the farmers earlier, there are people there who will take him at his word.
Yes, they will. And, he is trying to appeal to his base, and frankly, it's working. His poll numbers are at the high of his presidency among his base. So this is just a feedback loop that emboldens him to continue tweeting and continuing to dominate the narrative.
Well, we're all waiting for the next one. Okay, Bloomberg's Marty Schenker and Peter Elstrom. Thank you both.
Thank you.
The battle to be China's premier meal delivery service is heating up. Alibaba's platform, Ele.me, will spend $443 million trying to win over customers from rival Meituan. Ele.me's goal is to control over half the Chinese food delivery market. Meituan currently has a 59% market share. Ele.me, valued at nearly $10 billion, is said to seek at least $2 billion in funding to bankroll this battle against Meituan, which is considered the world's third biggest startup. Meituan is said to be planning an IPO this year, targeting a $60 billion valuation. Coming up, tech stocks may be hovering at records as earnings roll in, but one investor is pulling away from technology, saying the industry needs to be held accountable. We'll talk to him next. And if you like Bloomberg News, check us out on the radio. Listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Verizon wants to partner with Google or Apple when it rolls out the first super fast 5G service in California this year. Bloomberg has learned that Verizon wants one of those companies to provide television when the service is offered in homes in LA and Sacramento. The wireless giant came up short in trying to develop its own TV service. As earnings get into full swing, tech stocks have been surging, hovering at record levels. The sector continues to dominate the broader market, and as you can see from this chart in the GTV library, tech companies now make up a quarter of the S&P 500's value. But my next guest has a warning about the market euphoria, saying tech companies have amassed power not seen since the Gilded Age. Bill Smead, Chief Investment Officer and founder of Smead Capital Management, joins us now from Seattle. So this isn't a popular opinion, Bill. You believe that this financial euphoria episode, if you will, could permanently damage investors' long-term success. Why?
Well, first, even my friends are avoiding me right now. So the first thing to understand, there's like a three-part facet to all this. The one you mentioned already is that no one at Amazon and no one at Netflix considers themselves a consumer company. They all think they work at a tech company. So if you add Amazon and Netflix into the tech component of the S&P 500, it is now 30% of the S&P 500 index. And 30% is where it peaked out at the end of 1999, just to give you some flavor. The second thing is the valuations of a lot of these things from a historical perspective show you that it's very maniacal. Lately, if you watch your show for 2 or 3 days in a row, I'd love to get $5 every time somebody tells you about the total addressable market in groceries or the total addressable market in the pharmacy business. And so what that means is people are putting a lot of capital behind the potential. In a story you folks just ran, you talked about trying to get a big percentage of the grocery delivery. Well, grocery delivery is only about 2% of the groceries purchased in the United States of America. So if you just explode and triple that over the course of the next 5 years, you're going all the way to 6% of the business, and no one has proven an ability to make money. So it's a combination of a mania in terms of price-earnings ratios and popularity. It's a mania in concentration. And then the third thing is these are monopolies. We're dealing with 3 or 4 or 5 major monopolistic companies, and it would be remarkable from a historical standpoint if the United States government is willing to cede control of the United States of America to a for-profit business.
Tech accounts for about 25% of the S&P 500 right now. It is certainly much more than it's accounted for in the last 18 years, but it's nothing compared to dot-com bubble days. Would you say we are in dot-com bubble territory?
History never repeats itself, but it rhymes. And you have to hear the rhymes. I'll give you an example. In the dot-com bubble, we had eToys with a $10 billion market cap, $50 million in revenue, and a $40 million loss. It's not that kind of nutty. It's not an IPO coming out every single day for a year that doubles the first day and being a financial advisor and all your neighbors think there's something wrong with you because you're not getting them shares of those new IPOs. That's not what this is. What this is, if you own the entire Netflix corporation so far this year through the first half of the year, you would have had to write checks for about $2.8 billion because that's what their negative free cash flow is. And the last time I checked, the purpose of owning a business is generating positive free cash flow. In other words, there's some money the business made that you could use to your own benefit at the end of the year. So again, it's a different kind of mania. This is a large, mega large cap mania. It's not an IPO mania like what we saw back in '99.
Now, I have another chart in my GTV library that shows Facebook, Google, and Apple actually lagging behind Netflix and Amazon when it comes to year-to-date gains. We also see Amazon vying for that $1 trillion market cap, perhaps arriving there even before Apple. Do you think any one of these companies is better off than the others?
Well, it's certainly a bird in the hand is worth two in the bush. So Apple has already found over many, many, many years an ability to make billions and billions and billions and billions of dollars. So it's a highly profitable business with massive free cash flow. You know, if anyone wanted to pick on us as portfolio managers at Smead Capital, that would be the one they want to pick on us about not owning, because it fits a lot of the parameters that we look for in a common stock. But I don't spend very many sleepless nights worrying about whether I should have owned a stock trading at 150 times earnings, because the 5 to 10 year success of a stock price of a company that trades 150 times earnings is so terrible from a mathematical probability standpoint that it would be effectively a suicide mission from a historical perspective. And it might be different this time, but those are the 5 most damning words in investing.
If a correction is indeed coming, Bill, when is it coming? We thought perhaps with the data scandals and the controversy surrounding Facebook and Cambridge Analytica that would see the beginning of some sort of correction. There was a lot of tech volatility earlier in the year, and it has all, in essence, disappeared. We saw very strong earnings from Alphabet this week. If the bottom is going to fall out, when? Well,
first of all, that's one of the great challenges of ignorance avoidance, right? We try to practice ignorance avoidance. We have 8 criteria for common stock selection, so we pick the stocks we buy by companies that fit our 8 criteria and are available at bargain prices. But on the other hand, we try to avoid getting caught up in popular manias, and that's what this applies to. So the answer to your question is a really strong positive market dies because it runs out of buyers, not because some horrendous bad news comes along and causes a whole bunch of sellers to show up. You die at the top because you get to the last buyer. By the way, margin balances are at absolutely legendary level, absolute numbers in the United States right now. People are borrowing money to buy stock, and people are trading at discount brokers up 50% year to year. Obviously, a lot of people are trading these very successful momentum stocks. And so at the bottom of a market, you get to the last seller, right? Margin calls happen at the bottom. Somebody that would actually like to buy the stock is forced to sell. And what happens at the top is the short sellers get squeezed, and the last buyer is when the shorts clear their positions out. So I tell people you can't hold your breath till this is over. And then they ask me about Amazon as an example, because we're here in Seattle. I have no idea where that stock's going to peak. It could peak at $3,000 a share. But where it ends up when it does correct after that is probably not going to be a lot different regardless of where it peaks. In other words, if it peaks at 2,000, it'll bottom at a dramatically lower price. If it peaks at 2,500, it'll probably bottom at that same price it would have even if it hadn't gone up to there. Because on the way up, you go up on an escalator, and on the way down, you go down on an elevator.
Bill, you may have lost a few more friends there as a result of that segment, but we are happy to have you back and have this debate anytime. Bill Smead with Smead Capital Management in Seattle, thank you so much for stopping by. Coming up, the video game that made over $1 billion in just 8 months and caught the attention of the World Cup winning French national team. We're going to dig into the brains behind it. This is Bloomberg. Smash hit video games like Fortnite are not uncommon, but its revenues are. In Fortnite's first 8 months, it generated $1.2 billion in revenue. This year, it's on pace to hit the $2 billion mark, making its parent company, Epic Games, worth $5 to $8 billion. Fortnite rose to success through its freemium model and popularity among celebs like hip-hop superstar Drake. He set an all-time record on Twitch playing the game, attracting more than 500,000 streamers. Joining us now with more on Bloomberg's Devin Pendleton, who just wrote a story on this hit game. Devin, how unique is Fortnite's success here in the broader gaming scheme?
So, yeah, it's actually not that unique. Its success, its popularity is not that unique, but its financial success are quite unique. It has among the highest revenue per user in the industry, and that's really because of how much the players are spending in Fortnite's online shop, because as you mentioned, it's free.
So do we expect this game to have more staying power than, let's say, a Pokemon Go? It's already lasted a bit longer than that Flash lasted, but can this go long term?
Yeah, I mean, it already is proving that it has legs, like as you can see in the chart there. Most games kind of have an explosion in users in the first 6 weeks or so and then kind of die off. Fortnite is having the opposite phenomenon, and that's partly because it's very easy to play, but it's hard to master, so it's really getting people hooked.
So, what is next? I mean, they've got this $100 million fund to fund, winners in this prize pool. When do we expect that to happen?
So it's going to happen later this year. It's for the 2018 to 2019 season. So we don't exactly know how going to split that $100 million up among different competitions. But one thing Epic has said is that they'd like this to be more accessible. They'd like this to be broader pool of players than just the multimillionaire professional gamers who you see playing all the time. So this is a way to get even more users engaged in the game, to attract even more people and kind of spread the wealth.
How do they expect to do that?
Well, I think just word of mouth. They're going to have more people sort of paying attention. This $100 million is a huge, huge deal. They're going to be promoting it extensively. And then also you see a lot of celebrities, like you mentioned Drake, Antoine Griezmann, and Josh Hart are big players. So they stage big competitions. And then it's huge on social media. People are talking about it constantly. So it looks like it's going to be around for a while yet.
What's Fortnite's biggest competition?
So their biggest competition is a game called PlayerUnknown Battleground, and it's actually a game that they were kind of modeled after. PUBG, as it's called, sort of pioneered this battle royale. It was became extremely popular. It's multi-users, kind of fight to the death. And when the Epic developers were building Fortnite, they had a different version originally, but then they saw the popularity of PUBG, and they turned Fortnite into a battle royale kind of game, which really made it take off.
All right, well, we'll continue to cover the Fortnite phenomenon and see how long it lasts. Bloomberg's Devin Pendleton, thanks so much for joining us.
Thank you.
Coming up, Alphabet hits a home run in its second quarter with Google bringing in marketing dollars despite costly regulatory trouble in Europe. We'll discuss the consumer impact of the EU's action against Google next. And later, Facebook has problems, but it also has a bright spot in Instagram. We'll discuss later on. This is Bloomberg. This is Bloomberg Technology. I'm Emily Cheng in San Francisco. Executives at Google are giving no sign that a costly regulatory crackdown in Europe will hurt sales or profit anytime soon. Parent company Alphabet posted second quarter results that smashed Wall Street expectations. On the earnings call, CEO Sundar Pichai suggested the company wouldn't dramatically alter its Android strategy as it appeals.
We will always take a constructive approach. We'll appeal the Commission's decision and take the due process available to us. But we're also looking forward to finding a solution, above all, that preserves the enormous benefits of Android to users and so on. So there is more work to be done, and I think it'll become clear as we go along. But I'm confident that we can find a way to make sure Android is available at scale to users everywhere.
So what does it mean for regulation of the tech industry as a whole? Joining us now with more, we've got Bloomberg's Caroline Hyde in London and also in New York, Shira Ovide of Bloomberg Opinion. Shira, your column yesterday was titled, "Google Gives Investors a Reason for Short Memories." But is that a good thing?
We'll see, right? I mean, look, the fine from the EU, the $5 billion fine, was just a week ago, and as I noted this morning, it was literally a footnote in my column yesterday. That's how relatively immaterial it was to the results of the company, at least financially. So that's a pretty interesting thing to note. And the other thing is that the issue that had been freaking out Alphabet investors for the last few months was its spending, particularly these payments that it makes, revenue sharing payments to its partners like Apple and others. And the pace of growth of those payments moderated in the second quarter is the way they put it. And again, that gave investors in Alphabet some relief, although we'll see how long that relief lasts.
Now, Caroline, Google's appealing this ruling, but it hasn't been appealed yet, and they still face this $5 billion fine, which they will accrue over the second quarter. And the bigger question is, will handset makers now start charging Google to pre-install these apps that are in contention? Are investors correct in shrugging off these regulatory concerns?
Yeah, I think that's the key question. I mean, Mark Mahaney, you talked to him a lot at RBC, is saying, look, actually, the size of the fine was the great unknown, and maybe no key regulatory issues are in the back mirror. Yes, AdSense is still being investigated by the EU, but $5 billion, put that to one side. I think it's interesting as to whether or not we will see Alphabet's Google having to start to bid for the real estate that it might have to forego if they don't manage to appeal successfully. Remember, they got about just over 2 months to put in their appeal to the EU. If they do indeed have to change their business model, if they can't just automatically put Google Search and Google Chrome into Android devices, maybe they'll have to start to bid to win that sort of real estate against other app makers. But as many have been noting, particularly Nate Langston over here, a tech reporter for Bloomberg, has been saying, look, they've still got the deepest pockets around. I mean, as Shira was saying, look, $3 billion is net income what they managed to make despite a $5 billion fine. So overall, this is a company that can still splash the cash to ensure that Google Search is where it needs to be and therefore draw in the key advertisers.
Now, Shira, earlier in the show, we spoke to Bill Smead, an investor who's warning that participating in this tech euphoria is incredibly dangerous and will permanently damage long-term investor success. This, as Google reports, 25+% revenue growth. What about the bears here? Does he have an argument?
I think he does. And look, it depends a little bit on the company. There's a pretty big difference in the euphoria, quote unquote, between a company like Netflix or Amazon, whose stock prices have just grown by leaps and bounds, are trading at valuation multiples that are not normal, and then a company like Facebook or Google or Apple, which are trading at relatively modest valuation multiples for companies of their size and growth rates and profits. So that's a little bit of the difficulty of making kind of broad brush arguments about big tech, that there's a pretty big distinction between the maybe unsustainable valuations of companies like Netflix and Amazon and the valuations of companies like Alphabet and Apple.
Now, Caroline, what's interesting is that these tougher EU privacy laws have so far, it seems, helped rather than hurt Google. In fact, they've actually hurt smaller players that have had trouble becoming GDPR compliant. I asked Alphabet CFO Ruth Porat about this in a phone call before the conference call, and she said, it's still too early to tell what the real impact of GDPR will be. But, from the outside, from your perch, what does it appear, how does it appear these new regulations will actually impact these companies one way or another?
Well, this seems to be the effect that maybe the EU didn't realize it was going to have when it brought in these tougher privacy laws, when it made sure that key companies, when they do specific advertising, that they get my agreement that I'm allowed to be targeted in such a way. Well, suddenly the unknown consequence of this is it reinforces the duopoly, such as Facebook and Google, because they were compliant. They had the cash ready to be able to invest, to make sure ahead of the game they were asking their user base if they did indeed want to receive such targeted ads. They therefore have the trust of those who are looking to buy advertising that they can target and be compliant with GDPR. So therefore, the companies that are looking to advertise are going through Google's own services rather than rivals because they trust them and they ensure that they're not going to get any fines coming from the EU. So thus far, it looks as though actually it's benefited Google's bottom line GDPR compliance rather than in any way undermined their control of the market, which of course is exactly what the EU generally wants to do. It doesn't want to reinforce duopolies. It tends to want to ensure that competition is wide and varied.
Now, let's not have short memories ourselves, Shira. Let's remember that Netflix earnings results were not great, and we are still waiting for Facebook, Amazon, Apple. Could we have any unwelcome surprises?
Definitely. Look, all these companies, particularly Amazon and Facebook, they live or die based on their rates of revenue growth. And there's lots of concerns about Facebook, a company that has been basically in a PR crisis for 2 years. And the question is, to what extent does that begin to hurt its advertising sales, if ever? And investors are really anxious to see whether Facebook can continue to shrug off, again, a 2-year PR crisis in every corner of the globe. And I think that's an open question. At least on the user front, you're starting to see some slowing growth rates in terms of the monthly active users at Facebook, which again is a cause for some concern, at least to me. And again, on Amazon and Apple, there are real questions about whether those companies can sustain their rates of growth and what they're going to have to spend in order to keep up the growth rates that investors are used to. So yes, there is risk in all of those big tech names.
We're anxious to see the answers to those questions as well, and of course we'll be covering over the next couple of weeks. Bloomberg Opinion, Shira Ovide in New York, Bloomberg's Caroline Hyde in London. Thank you both. Sticking with earnings, Facebook has problems. The company has been facing increased scrutiny around data privacy and taking steps to address user safety. But these steps may be very expensive. Both could weigh on user growth when the company posts second quarter results Wednesday. But Facebook does have a bright spot. Bloomberg's Ed Ludlow explains.
2018 should have been a year of reckoning for Facebook after last year's concerns around fake news and Russian election meddling. But the social network's problems continue to pile up. It's been embroiled in a data privacy scandal. CEO Mark Zuckerberg has had to testify in hearings. And there's the constant controversy over how the company polices content on its site. Facebook's also seen a slowdown in user growth, particularly in its most lucrative market, North America. User engagement has also declined. But there is a beacon of hope for Facebook: Instagram. The photo-sharing platform's grown tremendously, with a $100 billion valuation and 1 billion monthly users. That's more users than Facebook had when it bought Instagram for just $715 million in 2012. And users seem to like what they see. In June, according to the analytics company SimilarWeb, Instagrammers spent an average 53 minutes a day on the Android version of the app. That's just 5 minutes less than Facebook users spent on their app. Investors are excited about Instagram's room to grow and how Facebook can tap into that. Instagram is drawing in new, younger users and is a big hit in new markets like Asia and Latin America. And it's no longer just about sharing photos. Video is also now in the mix after the platform launched IGTV, allowing anyone to produce and post long-form videos. The company hopes this will boost Instagram's well-established relationships for influencers and celebrities who draw in audiences to the app. In the past, Instagram used to rely on Facebook for its success. Now Facebook may depend on Instagram for its own future growth. Ed Ludlow, Bloomberg News, San Francisco.
Coming up, ride-hailing, bike-sharing, scooters. They aren't just upending commuting, they're changing the way drivers get insured. We'll discuss next. This is Bloomberg. As more people move to cities and change the way they commute, they are also changing the insurance industry. The advent of services like ride-hailing and bike-sharing has created a new opportunity that two insurance giants are betting heavily on. Tokyo Marine Holdings and Intact are leading a $90 million investment in Metromile. The allure? Pay by the mile auto insurance for people who are driving less. Here to tell us more, we've got the CEO of Metromile, Dan Preston, and in New York, Bloomberg Tech's Julie Verhage, who's been covering this startup and the insurance tech industry. So, Dan, just how many people drive so little?
It's actually most people. So it's about 65% of people drive less than the average. That's true in cities, it's true outside cities, and it's because people take alternative forms of transit. They may live close to work, a number of reasons.
How much is, Uber and Lyft and scooter sharing really the impetus for this?
That's, I think, part of it, but I think it's always been true that there have been low mileage drivers and high mileage drivers. What we're seeing is that that's starting to change. So people who used to drive a lot more are now driving less because they're taking scooters around or they're taking Uber or Lyft.
So how is that impacting the insurance business and your business?
Yeah, what I think that's doing is moving people around into kind of different kinds of products over time. So people who used to drive a lot more are now driving less, and so they're ultimately paying a lot more than they should be paying for their auto insurance. And so what per mile insurance allows you to do is pay for the amount of insurance you're actually using, and then with that ultimately pay less, especially if you're using some of these alternative forms.
Now, Julie, what are the trends you've seen in the larger insurtech space? I mean, wasn't it really hot and then it kind of cooled off?
Right. In the first quarter of this year, it was one of the best quarters for fundraising overall. And then this quarter, you saw a little bit of a dip. It fell 29%. But you have still seen a lot of fundraising. Largely, it's been a lot of term life insurance companies. Metromile is one of the only ones out there that actually does the insuring on a per mile basis. It's been one of them that you haven't seen too much competition to rise into yet. But overall, funding still pretty strong. It just took a dip from that first quarter, which was a really hot quarter for the sector.
Well, and Dan, you're competing with traditional incumbents, and often they can be clunky and not necessarily so tech savvy. What is your value proposition, and how do you compete in a market that has a lot of old rules?
Yeah, so per mile insurance in many ways was the starting point. We identified it's actually long been known that the number of miles you drive leads to just more accidents, and so the change ultimately was that these devices that we use to track the number of miles became possible, and we could use that in part of the insurance product. And so the challenge for a large insurance company is that because these low mileage customers are basically subsidizing the high mileage customers, it's really impossible to include this in an existing insurance company. So we needed to ultimately start the company from scratch to do that.
So, Julie, what are some of the other players out there that are getting attention?
Some of the other ones, like I mentioned, the term life are getting a lot of attention. You have Ethos, Fabric. Lemonade is a very hot renters and homeowners insurance startup that's out there that's raised money from the likes of SoftBank, Sequoia, and a lot of other big names in the space too. And then you've seen a lot of the incumbents actually start platforms that will invest in companies like Metromile or Lemonade or other ones out there to sort of try to form partnerships, get a taste of what's going on. Because like Dan mentioned, it's really hard to rebuild something that has been around for 50 to 100 years. Just taking out a legacy system and building something new is a lot easier than it sounds like. So that's an advantage that a lot of the startups in the space like Metromile have.
So Dan, you say that nationwide expansion is a big goal for you with this funding. When should we expect that?
Yeah, I think you'll see a lot of this over the coming year. We actually launched Arizona earlier this year, and we'll be launching a number of new states later this year and next year. So we're pretty excited about the nationwide expansion.
What's made it hard to expand nationally so far?
Yeah, so we've been rolling out a number of states until we decided to ultimately become what we call the full stack insurance company. So for a long time, we were an insurance provider, but we had an insurance carrier that supported us. The big transition for us was a couple of years ago where we decided that the biggest friction point for our customers was the claims experience. And we had an advantage in the way that we delivered our experience through the use of this device and being able to look at the accident. And in order to make all that possible, we actually had to ultimately become the full insurance company. So that big transition happened about 2 years ago, and we've been making that transition happen over the last couple of years. And then as of about 6 months ago, that's been complete. And so now we're back on the track to launch new states.
All right, Dan Preston, CEO of Metromile, will be following your intended expansion. Julie Verhage, Bloomberg Tech, thank you as always. Coming up, we all know names like Zuckerberg and Gates, but what about Partovi? We're going to take a look at how Ali and Hadi Partovi have quietly helped launch some of tech's biggest names. This is Bloomberg. Airbnb Airbnb received one of its biggest blows in its 10-year history last week. New York City Council voted to require the company to hand over the names and addresses of its hosts in the cities. According to officials, this information is needed to police Airbnb hosts that may be driving up neighborhood rents. Sources say this legislation could potentially cut Airbnb's New York City bookings in half, raising questions about the company's growth as cities crack down on restrictions. Airbnb has said the bill is in violation of user privacy as it prepares for its $140 million in gross bookings to drop by at least half when the legislation goes into effect in January. Well, a set of twins has been quietly stirring up Silicon Valley. Born in Iran, Ali and Hadi Partovi got their start when Microsoft bought out their respective companies, Link Exchange and Tell Me Networks. Today, the brothers have possibly the most impressive list of angel investments of anyone, including Facebook, Airbnb, Uber, Dropbox, and Zappos. More recently, the Partovis have expanded to philanthropy as the co-founders of nonprofit Code.org, with a goal to teach all kids across the U.S. how to code. I sat down with Ali and Hadi on this month's episode of Bloomberg Studio 1.0 to talk about these early investments, working with Mark Zuckerberg, and what went wrong with Uber.
I think investing in good people is really the most important thing, and every investor talks about investing in good people. We take it a lot more seriously. And the way I mean that is we will invest in something that we think is a bad idea if we like the person.
You also invested in Mark Zuckerberg. How did that happen?
We were lucky to get introduced via a number of routes when Facebook was still 8 or 9 people. And that was just an unbelievable thing to get to see this company at that early stage. A lot of people at that time were saying, why are you even involved in this company? I remember my wife saying at the time, why are you trying to get into fraternity parties or something? Because Facebook at that time was just in about 100 colleges, and it was kind of a way for college students to meet each other and flirt. But I remember from the very first time I met Mark, my immediate reaction was that this guy is more like Bill Gates than anybody else I've met. And he immediately reminded me of every time I'd interacted with Bill at Microsoft, and I just saw that the level of vision he had in terms of where he wanted to take it was so much more than the fraternity sort of angle. Dropbox Story is the one that is my favorite because it captures several parts of what Hadi and I brought together to investing. So there was a senior at MIT that Hadi already knew from having had him as an intern. His name is Mackenday. We were trying to recruit him to a small startup, and Mackenday had his eyes set on a bigger company because he was just graduating from college. We referred him to go to Facebook, which by then was maybe 200 people or so. But Hadi asked him, can you tell us who the smartest kids in your class at MIT are? And he said, well, everyone knows this guy, Arash Ferdowsi, but he's not going to join your startup either because he has his own new company. We then learned about Arash's startup, which was Dropbox, and Arash and Drew it was just a two-person company. At this point, we had them fly out to the West Coast and gave them coding tests to assess how good of computer programmers they actually are. And this is something that's part of our routine for all investments. Basically, if we're investing in a company, we won't do it unless the technical founder can pass a rigorous technical interview. And so based on evaluating Drew Houston's coding skills, we decided to invest in Dropbox. And we then spent the next several years, even until quite recently, helping Dropbox recruit engineers.
So what about Uber?
Uber, we weren't as early in. And in fact, I wish we'd been earlier investors in Uber because so many of our folks in our network were early investors in Uber. Getting into a later stage investment, not everyone has access. And part of what's enabled us to have access to investments like that, it's not just based on who we know, it's because we've developed a reputation for helping companies like Facebook or Dropbox with recruiting.
When you were watching from the outside at Uber, what do you think went wrong there?
It's really hard to manage hypergrowth, and I think there was a culture of, no holds barred approach to competitiveness. And I think there's some holds that you should bar. There's some lines that you should not cross. It's really hard for a company at large to know which laws are we paying attention to, which laws are we okay breaking, who gets to decide that. As you're going through hypergrowth at the same time, you just get into this cultural situation where anything kind of goes. And I think things got a little bit out of control.
Do you think at this late stage that Dara Khosrowshahi, who also happens to be your cousin, can turn things around?
I do. It's still an incredibly healthy business at its core. I mean, consider the tumult that's happened where the entire senior staff was axed, yet did anyone miss a ride? Did we hear any reports about cars stopping, drivers, not picking up their passengers? Dara is he's just a prince among men. He's just somebody that inherently, just because of the humility and the incredible respect that his personal character brings, people want to see him succeed. The sheer goodness of his character is enough to change some of the things, starting with changing the culture, as Hadi mentioned, and changing the way other people interact with the company.
That was Ali and Hadi Partovi talking about their early investments. You can watch the full interview on Bloomberg Studio 1.0 Wednesday, 6:30 p.m. Pacific, 9:30 p.m. Eastern. It was a fascinating one. Do not miss it. And that does it for this edition of Bloomberg Technology. On tomorrow's show, we're going to have full coverage of Facebook's second quarter results with analysts and investors joining us right here on the show as tech earnings are in full swing. That's all for now. I'm Emily Chang. This is Bloomberg.